Every freelancer has heard this advice. Set aside 30% of your income for taxes. Financial influencers say it. Your uncle says it. Even some accountants say it as a quick rule of thumb. But it is wrong. Not a little wrong. It is wrong by thousands of dollars in either direction, depending on your situation. And following it blindly means you are either hoarding cash you could be investing, or you are heading for a nasty surprise in April. Let me show you the real effective tax rates at 5 different income levels so you can set aside the right amount for your situation. Before we get into the numbers, let me explain why 30% is such a lazy number. Your actual tax rate depends on at least 5 variables: your gross income, your business deductions, your filing status, the QBI deduction, and your state. The 30% rule ignores all of them. It treats a freelancer earning $30,000 the same as one earning $150,000. It treats someone with $20,000 in deductions the same as someone with 0. It treats a single filer the same as someone married filing jointly with a $32,200 standard deduction. That is not a rule. That is a guess. Let me run the real numbers. For each scenario, I am using a single filer with modest business deductions equal to about 15% of gross income, taking the standard deduction of $16,100, applying the QBI deduction at 20%, and calculating federal taxes only. No state taxes, because those vary too wildly. Your state could add 0 to 13% on top of these numbers. Scenario 1. $30,000 gross freelance income. Business deductions of $4,500. Net profit, $25,500. Self-employment tax on 35% of that is $3,602. Half of SE tax deducted gives you an AGI of $23,699. Subtract the standard deduction of $16,100. That leaves $7,599 in taxable income before QBI. The QBI deduction of 20% on $23,699 is $4,740. Taxable income is $2,859. Income tax at the 10% bracket, $286. Total federal tax, $3,888. Effective rate on gross income, 13%. If you were setting aside 30%, you would have $9,000 in a savings account when you only owe $3,888. That is over $5,000 you could have been using all year. Scenario 2. $50,000 gross. Deductions of $7,500. Net profit, $42,500. SE tax, $5,999. AGI, $39,501. Minus standard deduction, $23,401. QBI deduction of 20% on $39,501 is $7,900. Taxable income, $15,501. Income tax, roughly $1,628. Total federal tax, $7,627. Effective rate on gross, 15.3%. Still roughly half of 30%. You would be over-reserving by more than $7,000 at the 30% rule. Scenario 3. $75,000 gross. Deductions of $11,250. Net profit, $63,750. SE tax, $9,000. AGI, $59,250. Minus standard deduction, $43,150. QBI deduction, $11,850. Taxable income, $31,300. Income tax, roughly $3,522. Total federal tax, $12,522. Effective rate on gross, 16.7%. Getting higher, but still almost half of 30%. Scenario 4. $100,000 gross. Deductions of $15,000. Net profit, $85,000. I did this full calculation in my last video, but the quick version. SE tax of $12,010. Income tax of roughly $5,420. Total federal tax, $17,430. Effective rate on gross, 17.4%. The 30% rule would have you setting aside $30,000. You owe $17,430. That is $12,570 you are locking up for no reason. Scenario 5. $150,000 gross. Deductions of $22,500. Net profit, $127,500. SE tax, $17,993. AGI, $118,504. Minus standard deduction, $102,404. QBI deduction, $23,701. Taxable income, $78,703. Income tax, roughly $12,500. Total federal tax, $30,493. Effective rate on gross, 20.3%. Even at $150,000, the effective federal rate is still under the magical 30%. So when does 30% actually make sense? There are really only two scenarios. First, if you earn over $150,000 and you live in a high-tax state like California, New York, or New Jersey, where state income tax adds 8 to 13%. At $150,000 with California state tax, your combined effective rate could hit 28 to 32%. Second, if you take almost zero business deductions, if you are a consultant with no home office, no equipment, no travel, and no health insurance deductions, your net profit equals your gross income and your effective rate climbs accordingly. For everyone else, here is a better framework. If you earn under $50,000, set aside 15 to 20%. If you earn $50,000 to $100,000, set aside 20 to 22%. If you earn $100,000 to $150,000, set aside 22 to 25%. If you earn over $150,000, set aside 25 to 30% and add your state tax rate. But honestly, the best approach is to not use a percentage at all. Run your actual numbers once using the method I just showed you. Calculate your real estimated tax for the year. Divide by 4. Pay that amount as quarterly estimated payments on Form 1040-ES. Adjust at mid-year if your income changes. This takes 30 minutes and saves you from either over-reserving or under-reserving by thousands. One more thing. Filing status matters enormously. Everything I just calculated was for a single filer. If you are married filing jointly, your standard deduction doubles to $32,200, which pushes your taxable income way down. A freelancer earning $100,000 married filing jointly with a spouse who has no income has an effective federal rate of roughly 14%, way below 30%. Stop following rules of thumb. Do the math once. Set the right number aside, and use the difference to actually build wealth.